April 24th, 2023, 4:42 p.m. Eastern Time. The earnings call lasted exactly 12 minutes. CEO Mike Roffler announced that $100 billion had vanished from the bank. Then the operator cut the line. No questions. No answers. Traders stared at their screens. The stock dropped 49% before the next sunrise. First Republic Bank was already dead. The world just hadn't been told yet. 6 weeks earlier, First Republic was the envy of American banking. They had perfection down to a science. When you walked into a First Republic branch, you didn't see plastic chairs and bulletproof glass. You saw antique furniture, fresh flowers on mahogany tables, the warm amber glow of recessed lighting designed by interior decorators, not contractors, and cookies. Always cookies, fresh-baked, warm from the oven, served on silver trays by employees who remembered your name, your spouse's name, your dog's name. The bank spent millions annually on those cookies alone. It wasn't a gimmick. It was a philosophy. Jim Herbert, the founder, had built the entire institution on a single premise: service conquers all. He believed that if you treated wealthy people like royalty, they would never leave. He was catastrophically wrong. The clients First Republic courted weren't ordinary depositors. They were tech founders with 9-figure exits, hedge fund managers with homes in Aspen and Malibu, surgeons partners at white shoe law firms, inheritors of old money who wanted discretion above all else. Mark Zuckerberg had a mortgage there. So did dozens of other Silicon Valley billionaires. First Republic didn't just bank them, it pampered them. It offered jumbo mortgages at rates that made no mathematical sense. 2.5% fixed, sometimes lower, interest only for the first decade. While other banks charged 5 or 6%, First Republic was practically giving money away. The wealthy clients loved it. They told their wealthy friends. The bank's net promoter score was higher than Apple's, higher than Ritz-Carlton. Clients didn't just like First Republic. They raved about it. They recommended it at dinner parties and on golf courses. The bank grew and grew and grew. The problem was invisible, buried in the balance sheet, hidden behind the cookies and the flowers and the handwritten thank you notes. First Republic was making loans at historically low interest rates and locking those rates in for decades. A 2.5% mortgage issued in 2021 would pay 2.5% until 2051. That was fine when inflation was dormant and the Federal Reserve kept rates near zero. But the Federal Reserve did not keep rates near zero. Starting in March 2022, it began the most aggressive rate hiking campaign in 40 years. Interest rates climbed from near zero to over 5% in 18 months. Suddenly, First Republic was sitting on a mountain of loans that paid almost nothing while the bank had to pay depositors competitive rates to keep their money. The spread turned negative. Every loan the bank had made was now an anchor. Every successful relationship was now a liability. The more clients they had acquired during the good times, the faster they were bleeding during the bad times. By the end of 2022, First Republic's unrealized losses on its loan portfolio reached 154% of its total equity. The bank was technically insolvent before anyone panicked. The balance sheet was a corpse waiting to be discovered. All it needed was a trigger. The trigger arrived on March 10, 2023. Silicon Valley Bank collapsed that morning in the fastest bank failure in American history. Depositors everywhere suddenly remembered something they had conveniently forgotten. FDIC insurance only covers $250,000 per account. If you had more than that in a single bank, you were exposed. And the clients of First Republic had far more than that. Their accounts held millions, tens of millions, sometimes hundreds of millions. All of it uninsured. All of it suddenly at risk. The bank run at First Republic didn't look like 1929. There were no lines snaking around the block, no desperate crowds pounding on locked doors. This was a rich person's bank run. It happened on smartphones and laptops, in beach houses and private jets. A client sitting on the leather couch in the lobby, eating a fresh cookie with one hand while the other hand tapped a screen and wired $10 million to JPMorgan. Another client on a yacht in the Mediterranean reading the news about SBB calling their wealth manager, demanding an immediate transfer. The money didn't walk out. It teleported. $25 billion left First Republic on March 10th alone. 17% of the bank's total deposits, gone in a single business day. The stock halted trading multiple times as circuit breakers kicked in to slow the freefall. The price dropped 40% by close, then kept dropping after hours. Jim Herbert, the founder, watched his creation hemorrhage. He was 78 years old. He had spent 40 years building First Republic on the principle that relationships mattered more than rates, that loyalty could be cultivated through service. His clients had received Christmas cards signed by hand, birthday calls from their personal bankers, complimentary tickets to sold-out shows. He had believed, genuinely believed, that those clients would stand by the bank that had stood by them. He was watching them abandon ship in real time. The people he had served were the people destroying him. Not out of malice, out of math. When you have $50 million in an uninsured account and you hear the word collapse, you don't think about cookies, you think about survival. The board met in emergency sessions. Lawyers were summoned. Investment bankers descended on headquarters. The options were grim. First Republic needed capital immediately. Not millions, billions. The bank reached out to potential buyers. It explored selling assets. It considered every lifeline imaginable. But the bleeding wouldn't stop. Every hour brought more withdrawal requests. The hole was getting deeper faster than anyone could fill it. On March 16th, a consortium of 11 of the largest banks in America announced they would deposit $30 billion into First Republic. JPMorgan put in $5 billion. Bank of America put in $5 billion. Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, and 5 others contributed the rest. Jamie Dimon, the CEO of JPMorgan and the most powerful banker in the country, personally organized the rescue. The press release called it a vote of confidence. It was framed as proof that the banking system was stable, that the big players believed in First Republic's future. The stock jumped. Headlines celebrated the intervention. For one brief moment, it looked like the bank might survive. The $30 billion was not a rescue. It was a tourniquet. The consortium deposits were uninsured, just like the client deposits that were fleeing. They came with strings attached. They carried interest rates that First Republic had to pay. And most critically, they did nothing to fix the underlying problem. The bank's loan book was still underwater. The mortgages still paid 2.5%. The gap between what the bank earned and what it owed was still widening. The $30 billion bought time. It did not buy salvation. Behind closed doors, the bleeding continued. Wealthy clients who had paused their withdrawals after the consortium announcement resumed them a week later. The news cycle moved on. Confidence evaporated. First Republic had stabilized just enough to stop the immediate panic, but not enough to attract new deposits or restore faith. The bank was in a death spiral, losing depositors steadily, unable to replace them, watching its stock price grind lower day after day. The earnings call on April 24th was supposed to provide answers. Investors wanted to know the damage. Analysts had prepared lists of questions about deposit flows, capital ratios, strategic plans. Mike Roffler, the CEO, took the call from headquarters. He had been appointed to the top job only months before the crisis. He inherited a situation that was already beyond repair. He spoke for 12 minutes. His voice was measured, controlled, almost robotic. He disclosed that deposits had fallen by $100 billion in the first quarter, excluding the consortium money. $100 billion. The number hung in the air like a death sentence. The bank's total deposits at the end of 2022 had been around $212 billion. Half of that was now gone. Analysts waited for the question and answer session. They had their hands raised, their Bloomberg terminals open, their follow-up questions ready. The operator came on the line. "Ladies and gentlemen, that concludes today's call." The line went dead. No Q&A. No explanation, no defense. Mike Roffler had said his piece and vanished. The silence was deafening. Traders looked at each other across desks. They hung up. The word spread through trading floors like a virus. Within minutes, the stock was in free fall. It closed down 49% that day. It kept falling in after-hours trading. By morning, the shares that had once traded above $170 were worth $3. The market had delivered its verdict. First Republic was finished. The final weekend was a formality. Regulators from the FDIC and the California Department of Financial Protection and Innovation worked through Saturday and Sunday to arrange a sale. They could not let the bank open on Monday. A disorderly collapse would trigger another wave of panic across the regional banking sector. They needed a buyer. They needed it fast. JPMorgan Chase stepped forward. Jamie Dimon, who had organized the $30 billion consortium 6 weeks earlier, now returned to claim the corpse. The FDIC agreed to share losses on the loan portfolio. JPMorgan agreed to take on the deposits and most of the assets. The price was approximately $10 billion, with additional loss-sharing arrangements that could cost the FDIC another $13 billion. On May 1, 2023, regulators seized First Republic Bank at dawn, before the branches opened, before the tellers arrived to bake cookies, before any client could walk in and demand their money. The signs came down. The system switched over. By the time the sun rose over San Francisco, First Republic no longer existed. It was now a division of JPMorgan Chase, the second-largest bank failure in American history, measured by assets, surpassed only by Washington Mutual in 2008. Jim Herbert did not give interviews. He did not appear at the announcement. The architect of the service-first philosophy watched his life's work dissolve into a competitor's balance sheet. He had believed that if you treated people well enough, they would stay. He had built a bank on trust and personal relationships and warm cookies in the lobby. In the end, the wealthy clients he had courted so carefully were the first to flee. They had private bankers at multiple institutions. They had accountants who calculated FDIC limits down to the penny. They had every tool to protect themselves, and they used those tools without hesitation. Loyalty was a luxury they could not afford when their fortunes were on the line. The employees learned their fate in waves. Some were absorbed by JPMorgan. Others were let go. The culture that Herbert had cultivated for 4 decades, the handwritten notes and the remembered birthdays and the obsessive attention to client happiness, vanished overnight. JPMorgan is many things, but it is not a boutique. It does not bake cookies. It does not cultivate the illusion of intimacy. The clients who stayed discovered that their new bank was efficient, professional, and utterly impersonal. The clients who had already fled discovered that they had made the right call. The total cost of the First Republic collapse is still being calculated. The FDIC's Deposit Insurance Fund took a hit of approximately $13 billion. Shareholders were wiped out. The stock that traded at $170 in late 2021 went to zero. Employees who held options watched their paper wealth evaporate. The consortium banks that deposited $30 billion got their money back, but the reputational damage lingered. They had publicly vouched for a bank that died 6 weeks later. Their vote of confidence looked, in hindsight, like a miscalculation at best and a PR stunt at worst. The lesson is brutally simple. First Republic was killed by its own generosity. It gave wealthy clients deals that were too good. Low-rate mortgages that locked the bank into decades of minimal returns. Interest-only terms that required no principal payments. VIP service that cost millions to maintain. The bank was popular because it was losing money to make its clients happy. When the environment shifted, when interest rates spiked and fear spread, that popularity meant nothing. The clients took the good deals and left. They had no reason to stay. The bank had trained them to expect below-market rates and white-glove service. When the bank needed them most, they were already on their helicopters headed to safer shores. First Republic bet on a stable world. Low inflation forever. Low rates forever. Wealthy clients who valued relationships over returns. The world changed. Inflation hit 9%. The Fed raised rates faster than anyone expected. The wealthy clients valued their money more than their relationships. Every assumption Jim Herbert had made turned out to be wrong. Not because he was stupid, because the world is unpredictable. Because a model that works for 40 years can fail in 40 days. Because cookies cannot stop a bank run. The branches are gone now. The flowers are wilted. The cookies are cold. First Republic exists only in case studies and cautionary tales, a reminder that no amount of service can substitute for sound risk management, a reminder that wealthy clients are the most dangerous depositors of all because they have the resources to flee faster than anyone else, a reminder that $30 billion delivered by the most powerful banks in America can still fail to save a dying institution. The money was real. The confidence was not. And confidence was not. And confidence, in the end, is the only thing that keeps a bank alive.